Hello, Martin. Bob here again, of course. Everybody knows the two of us. We do this every quarter, and I guess we'll just jump right into it here for the last part of 2025. But as always, it's been an interesting year. So let's see how the markets look.
Thanks for everyone for joining us again. We look forward to providing you with an important update this quarter. We're going to touch on a few things. The first one, of course, is markets and the economy. We've just recently had the Canadian budget been released, and that's something we want to touch on as well. But more importantly, we want to focus on how we're investing for the years ahead. We will also touch on some year-end initiatives, focus around mitigating taxes, as we always want to encourage our clients to utilize our tax consulting services here at Raymond James. So let's get started. Bob, can you touch on some of the important themes that continue to take shape in the back half of 2025?
Sure. Some of what we're going to talk about, we've been talking about for a little while, but there has been some big changes, and I think some shifts in how we look at things going forward. So, as you know, Martin, we'd like to be early on ideas and kind of invest in ideas that are when questions, not if questions, and take a position, be patient, and let the market come to us, right? So the market has come to us in some of our big ideas in the past few months. So the U.S. economy kind of limps along. It's having a when you actually look deep into the numbers aren't very good, but the headline numbers look to be okay, I guess. But what's happening here is as far as the interest rates are concerned, and the Federal Reserve and the pressure that's being put on the Federal Reserve by the political parties is not unprecedented, but it hasn't happened in a long time this way, and I think it's going to affect policy going forward. So that's one of the big things that we see. We also see some market dynamics changing and leadership changing in the market. From areas where everybody knows about what's happening to areas that nobody's talking about but are actually starting to outperform and do pretty well, and that includes a couple of things happening here in Canada. So we can jump into that.
It's exciting, and I think precious metals is one of the larger themes that seems to benefit from that. You alluded to it, but the Federal Reserve has been really lowering interest rates, something that we've seen in Canada for the last 2 years, but in the U.S., it's weird to see it happen at a time where, the economy is okay and they continue to lower and inflation's above 3%. So precious metals have definitely led out the gates, and, we'll touch on some of the things that are going to follow. One of the most important pieces that we've read lately is from Ray Dalio from the well-known Bridgewater Associates, and it's called Stimulating into a Bubble. And it's exactly what we're talking about here, how the U.S. Federal Reserve is lowering interest rates and shifting back into QE at a time when valuations are high, the economy is relatively strong, it's okay, and inflation's above its target while liquidity is abundant. So how does this differ from past environments when interest rates started to go down, and what are the potential implications of this?
Sure. Just to cover what you talked about before, you got to be ahead of the curve, and that's why before they started reducing interest rates 2 years ago, we were talking about precious metal stocks, and they were kind of, I always laugh, but I tend to think of it as the puking phase. We like to buy something when everybody's like, oh, can't own this; it's a terrible thing to own, and that's when we bought precious metals a couple of years ago. This year they're up 100%, based upon the fact that some sort of QE or some sort of interest rate drops were going to start to happen. And it's funny because once interest rates do start to drop, people say, oh, good, we'll invest in whatever does well when interest rates drop. And it's already too late. Markets already saw that coming. So, just on that theme, being ahead of the curve, back in 2020, we invested in uranium stocks and everybody hated it. Everybody thought that nuclear power was never going to be happening again and the whole world was going to be powered by wind or solar or whatever the case was. Well, now that we see that isn't necessarily feasible, nuclear energy is coming back into vogue. And what we see there is everybody's talking about it now. I mean, I don't see a day that goes by that we don't talk about nuclear power, and that's good. It'll probably be an okay investment. People are starting to ask me about it now. but the chance of gain or the quantity of the gain going forward is a lot less than if you bought it when nobody was talking about it. And by the way, those uranium stocks, the big ones, are up 7 to 10 times what they were 5 years ago. I mean, that's an incredible rate of return in a sector that nobody liked a few years ago. In gold and silver, we saw that a couple of years ago. Now we have to look and say, well, they're reducing interest rates, like you said, reducing interest rates into a bubble. We have to look at the implications of that and invest looking forward 18 months, not on what's supposed to happen when interest rates drop, because that's already kind of happened to a degree. So what's the next thing to go? And we'll talk about that a little bit later. But Ray Dalio, talked about the fact, as you said, that we're reducing interest rates while we're still in a bubble in many asset classes, U.S. valuation, that sort of thing, and how that's different than the past. I mean, usually the Federal Reserve's kind of a little bit behind the curve. I mean, this might be a genius move. Maybe they're ahead of the curve here, and they see bad things happening, and that's why they've started to reduce rates. But usually, kind of wait till things start to get bad, and then they reduce rates pretty quickly. We haven't seen things get too out of control yet. I still think a lot of things are being, suppressed and covered over. As Warren Buffett says, you don't know swimming naked till the tide goes out, right? We saw some issues back in 2023 with regional banks in the U.S. Haven't seen a lot since, but there's all kinds of backdoor things that they're doing to keep things afloat here. And I think maybe the Federal Reserve starts to see that, even though the markets are still trading at these kind of really high valuations. I think the Federal Reserve sees that, and they're saying everything under the surface isn't so great, so let's start to reduce rates. So that's what's a little bit different this time than what it's been in the past. And the second thing is, and I think this is really important, why they might be reducing interest rates at a little different time than they have in the past. I've said this for a long, long time, and nobody I don't think believed what I was saying, but, I really do think they cannot afford to have a recession anymore. The debt levels are too high. If they have a normal recession where the stock market drops precipitously, the economy goes into, pretty severe contraction for a period of time, they just can't take that. The debt's too high. They can't have the government running $6 trillion deficits and $7 trillion deficits. People are so maxed out. Even individuals are here in Canada, especially. They just can't have a normal recession. So they just got to keep stimulating, even though things are good, to keep things above water.
So the implications there are we might see a melt up in markets. We might see inflation pick up as a result, and those things are usually correlated with each other. And then there might be some tightening to bring it under wraps. Like already in Canada, they're talking about the next rate move might be a rate hike. So needless to say, the year ahead will be quite interesting, and it's just not a time to be complacent. So let's put some visuals to illustrate this.
And what you said about inflation, I just want to talk about inflation for a second. I mean, I think it's pretty obvious that they're going to let inflation run. So all the Canadians and North Americans who have, put up with inflation two or 3 years ago, I think it's going to come back at some point, and I don't think they're going to really care about doing a lot about it. And here's the reason why. The last time we were in this sort of debt situation was the end of World War II. And I've talked about this before, but, we were in a lot of debt at the end of World War II because we kind of had to be. If we didn't win the war, there was going to be a lot of implications, right? So to get out of that, for the next 7 or 8 years, they let inflation run pretty hot, and they kept interest rates low. And what happens in that case is you work off your debt because, $100 worth of debt now is only worth $50 down the road, and it becomes a lot less or a lot easier to control if you let inflation run and keep interest rates low. So I think, whatever is said, we have to look at what they're doing, and I think that's gonna happen. They're gonna let inflation run, and they're gonna try to keep interest rates down to some point. But we'll see what happens there.
Yeah, we'll talk about that in a bit. One thing we want to just bring up now is just an illustration of where markets are today in the U.S. because, they are getting quite stretched. So I will just share screen here. And Yeah, just want to explain what this is. And this is the MAPE ratio, which is a margin adjusted price to earnings ratio. There's a lot of common valuation metrics. And this is another one that just shows how bubbly the US stock market has become. It's now in the 99th percentile of historical valuations going back over 100 years.
And as you were saying this, I realized that a lot of clients and people that are listening to this don't really know what a PE ratio is,
Mhm.
or what growth or value or all this sort of stuff is. I just want to say, I think, the reason we bring these charts up is to show you that we're on top of things. We know, you know, what the range of expectations is in the future for different investments. And what I should say is that, there's always a bull market in something, right? So everybody talks about the market, and here we are with the market, the US market, and it shows that it's more overvalued than almost any time in history. And I think that's important, but that doesn't mean that there's not places to do well, right? And I think that's really important. It just shows you places to maybe stay away from. And we're not talking about market timing, not at all. It's just places to stay away from. We like to be in places where there's a margin of safety, where everybody's not there. And if we're not right, maybe we just have to be patient and wait for a little bit. What you want to avoid, and this is very important for clients to hear when we're managing portfolios, what's very important is to just not be in an area, have the portfolio exposed to an area that's going to drop 40 or 50%, in a short period of time. And, by staying away and steering away from things, not making a call on the market, but just say, hey, maybe there's better places to invest than something that's overvalued. That's why we look at these charts and we bring them up. And yeah, sure. What this chart shows is that valuations are very elevated. And what that means over the next, 10 years for any market, this could be any market. This could be the oil and gas, or it could be technology, or it could be the US market or the Taiwanese market. It just means that expectations going forward are pretty low. So in other words, there's not really going to be a lot of gains necessarily from whatever market is trade in the 99th percentile for valuation. It's probably going to be, flat to down over a very extended period of time. So that just leads us to other areas.
Exactly. And it can go higher, and it likely will
Sure.
over the
Yeah.
next few months. It definitely can, definitely because we've pointed out to the continued easing and the financial conditions you know, being made more abundant, supporting this. However, back in 2000, a good example up here, is when we saw the tech, boom bust. And we're not saying that's going to happen tomorrow, but eventually this bubble will pop. And that's an area that you don't want to be overly exposed in. A key example is Cisco Systems was the largest company back in 2000. And there's a lot of similarities to that company to some others today that are amongst the largest. And funny enough is it took 25 years for that stock to get back to those levels. Just today is it back at those levels. So it just shows that, it went down 88%. And it shows that it can take a very long time if you're a buy and hold investor in the wrong areas or in the wrong ETFs or passive strategies. You could be setting yourself up for low or disappointing results going forward.
And it's really interesting. You brought up Cisco there, and it's a good thing to bring up because I lived through that time. I remember Cisco Systems, biggest company on the market, went down 88% and didn't make it back for 25 years, as you said. And there's nothing wrong with Cisco. It was a good company. It was just the valuation was wrong. But there's a lot of similarities to what happened then and what's happening now. And just to dig a little bit deeper into that, Cisco, was the backbone of the internet, they called it, right? So everybody knew that the internet was going to be going to change the world, which it actually did. And smart people said, well, don't invest in internet stocks because those are overvalued. Invest in the backbone of the internet, which is Cisco Systems, and then invest in the fiber optic companies because, we got to get fiber. If people are going to use internet, we got to get fiber into everybody's household. And what they talked about is there's this last mile of fiber, which is the bottleneck, and that's the area to invest in. So that is and most of those fiber companies went bankrupt, actually. They went to zero. No, they didn't go down 90%, they went to zero because there was a complete overbuild in fiber at the time. And these companies were Global Crossing and 360 Networks here in Vancouver and things like that. So analogous to today, artificial intelligence is going to change the world. Well, there we are. We're right. Probably the same as the internet changed the world. And people say, well, don't invest in the artificial intelligence stocks because those ones may be overvalued. Let's invest in the backbone of artificial intelligence. Let's invest in data centers because data centers are going to be the backbone of the internet. That's like the fiber optic cable to make the internet work. Well, I don't have a crystal ball, but I can pretty much assure you there's going to be a tremendous overbuild in data centers, tremendous amount of leverage, and there's going to be some very significant issues because of that, and it's going to bring down a lot of sectors in the market.
Yeah, we've already noticed a few cracks. There's a lot of large caps, really big companies that are facing some issues today, and it's all around NVIDIA, the data centers, and a lot of the companies that they've been investing in and supporting. Like you said, there's a large profitable company that's doing great, and there's a lot of them around in the same ecosystem, some that are heavily not profitable and are starting to see some cracks. So I'm sure we'll talk about that in future videos. But what I want to do now is focus on what are smart investors doing today. And here we have a chart of Berkshire Hathaway's cash pile going back to the early 1990s. And of course, this is relative to their market cap, but this represents close to 30% of their whole portfolio is now in cash. And that's something that's very noticeable. So what's your commentary on this?
Sure. It's analogous back to the tech bubble, and there's some similarities and not some similarities. But I remember in kind of mid 1999, Warren Buffett said that, and he was only 75 years old, or 70 years old at the time. He's 95 now. He was 70 at the time, and he said that he thought there wasn't a lot of cheap things in the market. A lot of things were overvalued. There was bubbles all over the place, and he let his cash build dramatically. He didn't say the market was going to go down. He just said, I'm not investing. I don't understand the internet and the fiber cables and all the stuff that it takes to build that. So I'm going to build up my cash, and I'm going to look for bargains when they happen. And I remember, people didn't say too much at the beginning about that. And I think that's really important because they didn't really care. Then what started to happen is as the market started to continue to go up, this was in, kind of later 1999, I heard very vocal people say, Warren Buffett's old. He doesn't understand the new economy. It was the new economy at the time, it was called. He doesn't even have a computer, right? He still writes hand notes. He doesn't even type. And so how can he understand what's going on in the world? And then the market went up more, and then more and more people said, Warren Buffett's old, he's out of touch, don't invest with him, et cetera, et cetera, et cetera. And finally, when everybody pretty much believed that Warren Buffett didn't know what he was doing anymore, that's when the market crashed. He then took advantage of a lot of bargains in the market, spent a lot of cash, and did as he's been doing for 50 years. Did very, very well. So here we are again, building a lot of cash in the portfolio. He's been selling his Apple stock because he not that he doesn't like the company, but just the valuations, and building up cash to wait for the next bargain to happen. Now, it's interesting. I haven't heard a lot of people criticizing Warren Buffett yet. People are kind of in that nonchalant phase. But if the market continues to run here, then we're going to start to hear people say he's wrong. He doesn't understand. I mean, he's 90. He was old at 70. He's 95 now. So of course he doesn't know what's going on in the world. How is he supposed to know about AI? Well, and then there we go again. We don't hear that yet, but believe me, I'll be the first one to mention it to you if I start to hear that in a few months.
So let's shift gears now. Let's bring it back to the Canadian economy and the last federal budget. In 2025, the deficit's currently projected to be around 78 billion. That's pretty much around what was anticipated. But what was shocking was the budget foresees an additional 170 billion of additional budget deficits over the next 5 years, and when compared to the last projection under Trudeau, and there wasn't many game changers, but it just shows that balance sheets continue to expand, spending continues to happen, and we're at a time right now where they've lowered interest rates by a substantial amount, but our housing market's weak. Unemployment's high around 7%, and there's no bailout on the immediate horizon. It's just the market kind of has to face the new economic reality. So, what are your thoughts on the Canadian economy, and what are the impacts of lower interest rates have been on consumers or investors, if any?
Well, remember, the economy is not the market. So we can talk
Hmm.
about the economy, then we can talk about the market. And as far as the economy is concerned, artificial is the wrong word, but we had some short-term stimuluses to the Canadian economy, which caused excessive speculation. And by the way, when money's too easy to be made and there's a lot of speculation happening, there's also a lot of fraud happening.
Yeah.
And you don't see the fraud until after the fact. But we'll start to see that in real estate, I'm sure, in the next little while, and real estate related areas. But so what was our short term kind of stimulus to the Canadian economy? The immigration, right?
Yeah.
And from a number standpoint, bringing in a tremendous amount of immigrants, and that's probably good for the long term pension system of the country and the economy of the country. But when it happens, as far as the market was concerned, when it happened too fast, obviously you have to respond to what's happening right now, right? But when you respond to what's happening right now, and it takes a few years for that response to kick in, by the time the response kicks in, that short-term stimulus that was there is already gone. So that's what we're starting to see here in Canada, is the immigration, with recent changes has dried up completely, and I read the other day that the Canadian economy probably won't grow by population at all in the next year. It'll be flat completely. Well, the economy, the real estate's still building for what was the problem 2 or 3 years ago, right? So now you get this horrible circumstance where you get this kind of declining demand, but the supply is still growing rapidly based upon a few years ago. And you gotta do something about that, right? So that I think is going to be a big problem for the Canadian economy. I don't know, with $78 billion of debt, whether the government has a lot of money to stimulate out of that. I mean, they're trying to reduce rates, but the problem is reducing rates doesn't solve this problem, right? Reducing rates doesn't solve it, and that's kind of what happened in 2007 in the U.S. I mean, in 2008 they dropped rates pretty dramatically, but it really didn't fix the underlying problem at the time, and it's the same here in Canada. But it also creates opportunities here in Canada, and I think there's some opportunities. I'll mention this again, and you'll hear it from me a lot of times, but that is, in investing, it's a little bit different than the economy. The Canadian economy can be bad, but the market can be good, because in order to do well in investing, you just can invest in something that stops getting worse. Stuff doesn't have to get better. It just has to stop getting worse. Now, as far as Canadian real estate, I think it hasn't stopped getting worse yet. It's still getting worse. But in some of the other areas that the market looked at, that maybe previous governments were obstructing things have stopped getting worse and they're getting better. We can talk about that.
Yeah, I'm going to jump right into that.
Yeah,
Real estate, that's something that a few clients have brought up over the last 6 months in terms
sure.
of, the publicly traded REITs. Are there opportunities there? And, like you said, there's always a bull market in something. So retirement REITs have done well, and other REITs have teetered, and some have struggled, reflecting the environment. But I can tell you, as we've seen in countless sectors throughout past decades, is when it seems like the worst is happening outside in the real world, it's likely the bottoming, or the bottom has already happened in the public markets, because markets are forward looking. So eventually we will be looking at real estate as an opportunity, but today we're going to shift gears as it's something else. And the next area that we believe that one can invest in is energy. We think it's clearly underloved. It's reached the lowest percentage of the S&P's market cap in history. You sent me that today. And more importantly, it's the clear beneficiary of the increased energy usage from the AI data centers. Let's talk a bit more about that.
And Canadian energy in particular, and
Mhm.
there's a few reasons for that. Back to my statement, things have stopped getting worse for Canadian energy. They haven't got better yet, but they've stopped getting worse. And interestingly enough, nobody knows it, nobody cares. Just like nobody cared about precious metals or metal stocks actually outperforming the U.S. market up until a few months ago, and then it just really was a hockey stick after that as far as the upside. But the same thing's happening in energy. I just read this morning actually that Canadian energy stocks this year have outperformed the U.S. market and outperformed Nasdaq. Who would have thought? The most hated sector, and it's still the most hated, and nobody knows. I mentioned it to a senior kind of big macro person the other day, and they said, "What? You're kidding me? I don't even pay attention to that." Right? And that's great. That's where you want to be. Something that is actually starting to outperform that nobody pays attention to. And Canada, our pipeline capacity is a little bit better. We have to increase it over the next little while, but suffice it to say, the Canadian energy companies are getting better um, dollars for each barrel of oil than they were a few years ago. And even though oil hasn't done well in price and gas, these companies are actually more profitable than they were at higher prices. And you're starting to see that in stock prices. So we're particularly positive on Canadian energy.
Yeah, I used to, I spent 7 years in Calgary, and back then the debt levels were pretty substantial. And over the last 4 years, you've seen that these debt levels been paid off by these energy companies, and they're managing a much more prudent ship relative to what they were in the past. And now they're taking excess capital, they're increasing dividends, they're buying back shares, just things to increase the value of a company and return to shareholders. So that's one element of offense. And I just want to touch now, last topic is the barbell approach that we have in our portfolios today, because we've highlighted some risks, some overvaluations in the market, but also some opportunities. So can you talk generally about the barbell approach that we have for
Yeah,
clients today?
yeah, there's two ways to kind of shift assets when you're managing portfolios. And one of them is, tactical, where you're trying to kind of time the market and you're saying, well, this is going to do well, so let's go here, this is going to do well. And, sometimes it works, sometimes it doesn't. Over long periods of time, it doesn't work too well. The other way is strategically, right? Strategically is saying, let's build a portfolio where, different components of the portfolio do different things. And if I can say, that's the biggest mistake that most people do, is they want everything in their portfolio to go all up at the same time. Well, what they don't realize is that everything's also going to go down at the same time when it's time to go down. If you can strategically put assets in there where you say, we have a range of outcomes that are going to come at us in the future, but with this different range of outcomes, some of the assets we have will do well, and some of the assets won't do well. But the assets might, one asset might do 10% over the next 5 years, the other one might do 10%. But if they get there in a different way, now you got a portfolio that doesn't go up and down very much and still gets you to the end place. And if you actually strategically kind of rebalance along the way, you actually get better returns with less risk when you do that, right? So that's what we're trying to do. We won't get into too many details, but in a lot of portfolios, we're starting to put a product into the portfolio which can take advantage of this volatility in the market. And if all these things that are overvalued in the U.S. market all come down, which they will at some point, I mean, nothing's a guarantee, but history's showing they will at some point, then this product will go up pretty dramatically. And last time this happened was 2022, and it had a great run at that time. If you had that in the portfolio properly at that time, then you would reduce your risk pretty significantly. So that's the barbell approach, taking one side and being offensive and saying, hey, there's always a bull market in something. Let's find something where there's going to be a bull market in. And if we're a little bit off in our timing, for example, well, let's have some defensive things here that if it doesn't work out in the short run, or if something happens that's unexpected, it's going to help the portfolio. And I think by doing that, you look at the people that have the least downside risk over periods of time are the people that have the best performance over long periods of time.
Yeah, and they're able to sleep at night. And I think that's
Right.
very important. And also, when the worst is happening,
Hmm.
they're not motivated to make the improper decisions that are, dictated by their
Right.
emotion. They're able to rely on us and make sound decisions to take advantage of opportunities versus reacting to, the reality that many are facing.
Right.
So to finish up, we want to just discuss year-end tax planning. For our clients, one of the things that we do at the end of every year is, look at their realized capital gains for the year and see if we could, do some proactive tax selling. So that could be, selling one company and buying a competitor. So perhaps, selling Rogers and buying Bell, something like that. That's very similar to reduce one's tax bill. So that's something that we'll be doing. And we're also reaching out to clients who are interested to do charitable donations. If you have intent, if you have the capital and you want to do so, that's another great way. Can you touch on the RJ Canada Foundation, Bob?
Sure. Advanced planning is a big part of what we do, and here at RJ, there's a lot of depth of teams. Company manages $2.5 trillion of assets, and with that comes a lot of depth in lots of areas, from cross-border tax planning to charitable giving to high-level tax consulting. All of that's available, and we use that for clients that need it. So yeah, at the end of the year here, I mean. I always say the only thing that's important is how much money you make after tax, right? If you make 10% and you pay 7% of it in tax, well, you only made 3%, right? So it's important to try to think about that, and we do that at the end of the year by doing some tax planning and capital loss planning. But remember that the portfolio going up is not kind of the end of the story. The reason we all have money, the reason we save money, the reason we try to invest it is to achieve a certain goal, right? And that goal might be to buy a house, or that goal might be to retire comfortably, or that goal might be for some people to make the world a better place, right? And so that's why the charitable giving comes in, and when people get up to a certain asset size, or even not, they say, hey, I want to give back. I want to help out some people, and charitable giving is a great way to do that. I have a charitable foundation, as you know, Martin, in the name of my father, who is deceased. But people can um, um, you know, put some money into the Raymond James Foundation. There's a minimum amount that you can put in there, but then the money is actually invested. We manage it. I manage my own foundation. And if the money's making money for you, you can give more away in the future without actually putting more money in, which is fantastic, right? So if you can manage a foundation, have the money grow for you, and then give the excess earnings away to charity, that can go on for a very long periods of times, and you can change people's lives and change the world. And our successes with our money and our investing can go to help other people, which is fantastic. Gives people purpose too.
I agree. And another last point on that is if you do have younger children, it is a phenomenal way to enhance and teach great values to your younger children. And I know that you've utilized that with your children to get them involved and get them passionate about, the causes and the dollars that are going towards them.
That was one of the reasons I started the foundation, is to get, my kids are 7 and 5 now, to kind of get them involved, think about charitable giving, think about helping out other people. And I just think it creates good values. I'll continue to talk about that with them over the next few years. I might be a little bit early for one of them, the little 5-year-old I mentioned last week, that maybe we could help out some other people by giving some money. And he said, "But I'd rather buy more monster trucks, Daddy." So, that's okay. We'll buy more monster trucks, but maybe we'll talk about it next year. He'll understand. We'll see.
Well, that's awesome, Bob. Really
Yeah.
appreciate your time today. And for, all of our clients, anyone listening, if you'd like to contact us to meet with one of our tax consultants, please do it before year end. And otherwise, thanks for joining us. We look forward to talking to you next time.
And I'll say one more thing, Martin. A lot of our clients were familiar with Tanya. Tanya decided to retire, spend time with her family, and that's great. We're in touch, and I hope that's a great change for her. Emily's taking over some of Tanya's duties. You're taking over some of Tanya's duties, and we'll introduce Emily probably in the near future. She's been on the team for a while anyway, but we'll put her on one of these videos and introduce her to everybody formally through the through this meeting.
Look forward to it. And yeah, we might have a new employee at that point in time too
Sure.
to introduce everyone towards. So yeah, thanks again, and we'll touch base with you next quarter.
Thanks.
Thanks.